If your agency is an S corporation, you may be blocking yourself from one of the most powerful tax breaks available on a future sale. But don't rush out and convert to a C corporation. That move may help or may hurt. It can also create a tax mess if you do it wrong. Hi, I'm Craig Cody. I'm a CPA and a certified tax coach. I help marketing and PR agency owners keep more of what they make through proactive tax planning, better cash flow, and smarter financial decisions. Craig Cody and Company's core positioning is proactive, year-round tax planning for agency owners, not reactive tax prep after the year is over. And today we're talking about Section 1202, qualified small business stock, and whether an S corporation can restructure to take advantage of qualified small business stock benefits. This is not something you decide from a TikTok clip or a 5-minute article. This is something you must plan for carefully. Point 1, understand what Section 1202 actually does. And let's start with the basic idea. Section 1202 can allow certain non-corporate taxpayers to exclude gain from the sale of qualified small business stock. In plain English, if the stock qualifies and you meet the holding period and other requirements, part or all of the gain from selling that stock may be excluded from federal income tax. And that's why agency owners who are thinking about a future exit should pay attention. The article in the notes will explain further, but qualified small business corporations are C corporations. For qualified small business stock acquired after the applicable date, the code now includes a tiered exclusion. 50% savings after 3 years, 75% savings after 4 years, and 100% savings after 5 years or more. And this is basically on about $15 million of gain. The IRS also confirms that qualified small business stock must be stock in a C corporation, not an S corporation, and that the gross asset threshold is $75 million for stock issued after July of 2025. Sounds attractive, but here's the catch. Your agency does not qualify just because it has revenue and employees and growth potential. The stock has to qualify, and the company has to qualify. The business activity has to qualify, and the timing has to qualify. Point 2, your S corporation stock is the problem. Many agency operators operate out of S corporations, but S Corp stock itself cannot be qualified small business stock, and that's a key issue. The attached documents will go into it further, but I suggest you talk with your CPA if you think you meet this criteria. So if you're thinking right now, great, I'll just sell my S Corp agency someday and use Section 1202. Nope, not going to work. That's not how it works. You need to ask a better question. Can we restructure something today that may qualify later? And that's a strategic planning question. And it has to happen well before the exit, not when the buyer is already at the table, not when the letter of intent is signed, not when your attorney is already drafting documents. By then, it's too late. You're recording history. Let me know in the comments if you're building your agency to sell someday, or you mainly focused on profitability and cash flow right now. That answer will change the strategy. Point 3, there are several restructuring paths, but none are automatic. The article lays out a few possible paths for an existing S corporation. One option is to liquidate the existing S corporation and contribute the assets to a new C corporation. That may have little or no tax cost if the S corporation does not have highly appreciated assets, which most agencies don't, but if it does, taxable gains can be triggered and passed through to the shareholders. Another option is a direct conversion by revoking the S corporation status, but this only applies to S corps that originally began as C corporations and did not elect to be taxed as an S corporation because they were LLCs. A third option is having the S corporation own a separate C corp subsidiary that may qualify as qualified small business. A fourth option is an asset drop-down where the S corporation transfers assets into a newly formed C corporation. But there is an important limitation. Gain tied to the assets originally transferred into that C corporation do not qualify. Only future appreciation qualifies. And that could be a big deal, because if your agency already has significant value, client contracts, intellectual property, or brand equity, the timing matters. You cannot just move value around and assume all future gains become tax favored. That's where agency owners get themselves into trouble. Point 4, agency owners need an eligibility review before they chase this tax break. This is the part too many people will try and skip, because not every business qualifies. The IRS instructions state that certain service businesses are excluded, including consulting and businesses where the principal asset is the reputation or skill of the employees. Once again, refer to the article in the notes. So let's go back to marketing and PR agencies. You cannot assume that you qualify. You need to look look at what the agency actually does. Is it pure client service? Is it consulting heavy? Is the value tied mainly to the reputation and skill of the team? Is there a separate product or platform, technology or business line? Marketing or PR agencies do not automatically qualify. So the honest answer is we need facts. And this is why entity structure is not just a legal decision, it's a tax decision, it's a cash flow decision, it's an exit planning decision, and your CPA needs to be involved before you make the move. So here are some key takeaways. First, Section 1202 can be very powerful, especially after the recent expansion of the qualified small business stock benefits. Second, S Corporation stock itself does not qualify. Third, restructuring may be possible, but each route has trade-offs, tax consequences, and timing issues. Fourth, agency owners need a real eligibility review before assuming this applies to them. The goal is not to chase a tax strategy. The goal is to build a more valuable agency, protect cash flow, reduce taxes legally, and avoid surprises when it's time to scale or exit. If you own a marketing or PR agency and you're wondering whether your current entity structure is helping or hurting your long-term tax strategy, let us know. Remember, the best tax savings usually don't happen at filing time. They happen when you plan ahead. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got two things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.